If you are new to investing, one of the most common advice that you will get is to invest into the S&P 500. It holds some of the best companies in the world, gives a good 12% long-term annualized returns, and best of all, has the seal of approval from the god of investing himself, Warren Buffett. Then you'll be like, okay Ken, and happily search how to invest in it. And that's when you realize there's a whole bunch of S&P 500 ETFs which to invest in. So in this video, I'll give you a detailed breakdown of everything you need to know about investing in the S&P 500. What exactly is the S&P 500? Which is the best ETF? What broker to use? And some things to take note of. Alright, let's jump right in. So the S&P 500 is basically an index tracking the top 500 publicly traded companies in the US. If we look at the holdings, you will see familiar names like Apple, Microsoft, Amazon, Google, and of course Tesla. Almost 1/3 of the holdings are in tech, 14% in healthcare, and 10% in financials. But it wasn't always this way. Back in the 1980s, industrial companies dominated the S&P 500, and the top holdings were companies like IBM, AT&T, Exxon, and Shell Oil. As time passed, newer and more profitable companies appeared and took over the place in the top spot, while companies that are no longer profitable are kicked out of the S&P 500. And that's why the S&P 500 is so good. It's basically a momentum strategy where it's constantly pushing the winners towards the top while removing the losers. As a result, you get this beautiful chart where the S&P 500 gave an annualized 11.88% return over the long term. But before you say, so you mean I will confirm plus chop get 12% return if I invest in this? No, I don't mean that. That's just the past returns, yeah? And like all the seafoods say, past returns doesn't guarantee future performance. If we look at the 10-year annualized rolling returns, there are periods where the S&P 500 barely gave any returns, and there are times where it gave over 15% returns. So the return is not guaranteed and is totally dependent on the period that you are investing in, yeah? Okay, enough of the S&P 500. Let's talk about how to invest in it. But first, this S&P 500 chart that you see on Google is actually just the index, and you can't really invest into this index because it's just the ranking of the top 500 companies. Instead, you will need to invest into either an ETF or a mutual fund that tracks the S&P 500 index. But I will just ignore mutual funds here because it's hard to buy US mutual funds as a non-US resident. So let's focus on ETFs. But with so many ETFs out there, how to choose? So here's a super big comparison table. Okay, I know it looks complicated, but don't worry, it's actually quite easy to understand. Let's go through it together. Here, we have the top few S&P 500 ETFs. There are a lot more ETFs out there, but we will only be focusing on the more popular ones. The funds are either domiciled in the US or in Ireland, or basically in the UK. Depending on where the funds are domiciled at, they will have different tax implications. First up, dividend withholding tax. Here's how this works. When a stock pays out dividend to an US domiciled ETF, there's no withholding tax. But if you are investing from a non-US tax treaty country like Singapore, the fund will withhold 30% of the dividend before giving you the remaining amount. So you will lose 30% of the dividends when it reaches you. On the other hand, when a stock pays out dividend to an Ireland domiciled ETF, because there's a tax treaty, it will only withhold 50% of the dividend from the fund. Then, because Ireland has a tax treaty with many countries including Singapore, it doesn't withhold any dividends from you. So you will only lose 15% of the dividends. So that's the dividend withholding tax. Quick pause. Here are a few reasons to sign up to Moomoo Singapore. First, tons of free gifts. For new users, when you deposit $100, you will get a $2 cashback daily for 10 days. Then, when you deposit another 2K and perform 2 buy trades, you will earn a free Coca-Cola stock worth around $80. Then, finally, if you deposit 10K and perform 7 buy trades, you will earn a $108 cash coupon. But wait, that's not all. There's also a new promotion for existing users. By depositing money or transferring up to 50K worth of shares in, you will earn up to $200 worth of rewards. So that's nice. Besides that, the app lets you easily keep track of companies' news and announcements, analyze the company from both the technicals and fundamentals to help you make better decisions when investing in the company. And also, they have an active community where you can discuss stocks and investments with one another. So if you are interested, you can sign up to Moomoo Singapore using my link down below. With that being said, let's get back to the video. The second implication of investing in US ETFs is that if one day you touch wood pass away, there will be something called estate tax on your investments. Or sorry, not your investments, it's your descendants' investments now. If the amount is more than 60k, it will be taxed anywhere from 18% all the way to 40%. Then there's a third kind of tax called capital gains tax, where if your investment goes up and you make money, the government will tax your profit. But in many countries like Singapore, there's no capital gains tax when you sell your shares, yeah? So you can ignore capital gains tax here. The only two taxes you have to bother about are dividend withholding tax and estate tax. Next, US domiciled ETFs like VOO, IVV, and SPY are listed on the New York Stock Exchange, while S27 is listed on SGX. But even though S27 is listed on SGX, it's still trading in the US dollar, yeah? Finally, all Ireland domiciled ETFs are listed on the London Stock Exchange. As for expense ratio, both VOO and IVV have the lowest expense ratio at 0.03%, while Spider ETFs have the highest expense ratio at 0.09%. Meanwhile, all Ireland domiciled ETFs have the same 0.07% expense ratio. For total net assets, it isn't that important to us. I just put it here to show you that different ETFs can have different total net assets. The more important part is the average trading volume, because the higher the volume, the better the bid-ask spread. And that will mean you will get the best possible price when trading the ETF. So if we put VOO, SPY, and S27 side by side, SPY, which has the highest trading volume of 88.79 million, it has the best bid-ask spread at just 2 cents wide, while VOO, which has 3.92 million average trading volume, has a 6 cents bid-ask spread. And with S27 pathetic trading volume, its bid-ask spread is super wide at $22. So that's the effect of trading volume. The bigger the volume, the better the bid-ask spread. Next, for ETFs that are distributing dividends, they currently have a dividend yield of around 1.6%. And for ETFs that are not distributing dividends, they will just reinvest the dividends back into themselves and activate the magic of compounding. Finally, there's ETF price. But it doesn't really matter as most brokers let you buy fractional shares nowadays. So now, the question is, which ETF should you go for? Should you go for US domiciled ETFs that have a 30% withholding tax but much lower expense ratio? Or should you go for Ireland domiciled ETFs to have a lower 15% dividend withholding tax but have a much higher expense ratio? It depends. If you're only trading the ETF over a short period, the expense ratio and dividends are not important to you. So you would want to go for the ETF that has the highest trading volume so that you have a good bid-ask spread. In this case, it's SPY. But for the rest of us who are planning to buy and hold over the long term, like every good investor should, which should we go for? Let's compare this. VOO has a 0.03% expense ratio, while CSPS has a 0.07% expense ratio. Let's say the dividend is 1.6%. Okay, I know that CSPS doesn't distribute dividends, but the reinvested dividends will still be subjected to the withholding tax, yeah? For VOO, 30% tax on the dividend equals to a 0.48% fee. And for CSPS, 15% tax on dividend equals to 0.24% fee. So if we sum it up, VOO has a 0.51% total fee, and for CSPS, it's just 0.31%. As you can see, even with a higher expense ratio, Ireland domiciled ETFs will still end up cheaper than US domiciled ETFs. So let's all in into Ireland domiciled ETF. Hold up, there's a small fine print to this. If you check brokers like Interactive Brokers, for US ETFs, the minimum fee per order is 35 cents, while for UK ETFs, it's $1.70. So if you are just buying a small amount of shares, like $100, $200, it's actually cheaper to go for US ETFs. But if you are buying like 1k or 2k worth of shares, it will be worth it to go for UK ETFs, despite the higher commission fee. Then the next question is, Should you go for dividend distributing ETFs or dividend accumulating ETFs? For this, it depends whether you want passive income or not. If you don't need passive income, just choose dividend accumulating ETFs because by reinvesting into itself internally, you will avoid getting hit by another round of broker commission fee. But if you are planning to use the dividend money for something like buying other stocks or eating cai fan, then go for dividend distributing ETFs. Alright, let's sum this up. If you are just trading for the short term, go for SPY as it has the highest trading volume. If you are investing over the long term, go for any of the Ireland domicile ETFs to save on the fees. But I would recommend going for CSPS as it automatically reinvests the dividends and has a high trading volume. However, that's only if you are investing a big amount like 1K or more. If you are just investing a small amount like $100, go for VOO or IVV to save on broker commission fee. Finally, which broker can you use to trade these ETFs? If you are investing in ETFs that are listed in the New York Stock Exchange, you can just use any brokers out there that support US stocks. Or you can also check out my video here to find out which are the best brokers to use. But if you want to buy an ETF that's listed on the London Stock Exchange, the cheapest broker to use would definitely be Interactive Brokers. So if you need that, you can just sign up using my link down below. If you have any more questions, you can join my fast-growing Telegram group to ask me or the members any questions that you may have. Anyway, that's all for this video. Hopefully, you find it useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.